Good morning. It is Friday, February 8th, 2019, one day after my birthday party. And
Happy
I'm not,
birthday.
thank you very much. I am not
Yeah.
hungover. I
Mhm.
had a couple of drinks, played a little poker, hung out with a girlfriend. But starting my 50th tour around the sun. So I'm 49 years old, and at the end of this year, I'll have completed my 50th year, and then they'll call me 50. I'm not really
Mhm.
sure why it works that way. I guess we're zero when we're born. Um, so I want to talk about what's really going on in the markets and pound home a couple of topics that I think that people just keep forgetting or ignoring or not buying into. I'm not really sure what it is, but if you want to be a good investor, if you want to understand the economy, you have to understand the things that we're going to talk about today because they're not going to change for decades. Literally, these themes will be on the table for decades. So we're going to look at the big picture. We'll take a look at some of the little things going on now. And when I say little, I mean little. They affect the next year or two. But for the next decade or two, or probably three, we are going to be dealing with some things that are monumentally important and encapsulate everything else that will go on for the rest of our investing lives. So when I say things like slow growth forever, it's not a euphemism. It's not an exaggeration. The planet's economy, the world economy, is never, ever going to grow in this century like it did in the second half of the last century. Sure, there'll be some up years that are really big up years, but the reality is that the demographics, the global debt, and other factors do not allow for the economy to ever grow at 4 and 5% for a sustained period of time ever again. And if you don't accept that, I'm going to try to convince you of that today, but if you don't accept it, then you are doomed to be one of the people that I take money from over the next couple of decades. So let's start with understanding market dynamics. I wrote an article in the middle of December talking about the four pieces of missing money crushing markets. And subscribers to Margin of Safety and Fundamental Trends know that I've been talking about this for months. I wrote an article way back at the start of the year that talked about slow growth forever and the other things affecting the economy and why we were going to see more volatility in second half of 2018, 2019, and potentially and probably 2020. We'll get to a binary event that will determine whether we head into recession in the short term or if we get a resumption of the growth and of not only the economy but the stock market going into next year. So let's take a look at how market dynamics work. If you ever took economics, Econ 101, 102, 301, 302, the micro and the macroeconomics, David, what is the basic equation that everything else is built over? Supply and demand are determinants of price, right?
Correct.
So if supply is high for something and demand is low, what happens to price?
And it drops.
The price
It
comes
decline.
down. Exactly. Yeah. And if the supply is low and the demand is high, then what?
That's when you get the higher prices.
Higher prices. So why wouldn't the supply and demand for stocks and other assets work exactly the same way? When demand is high and supply is relatively stable or decreasing, then you'll probably get rises in price. But if demand falls for assets in general, then you'll generally get falling asset prices. So when we took a look at the economy last year, we talked about the fact that there were pieces of money that just weren't in the market anymore. So the first and most important one is that the demographic headwinds to the economy are very real and very permanent. You can't fix demographics in a year or with any type of government policy. Sure, in China, they're not limiting people to one baby anymore, but it's going to take 2 to 3 decades for it to matter, right? You're not just going to all of a sudden get, 100 million babies there that suddenly start spending money. They walk out in their diapers, get a job, and they're like, hey, let's go spend some money. I'm a baby. No, that's not how it works. It takes decades for people to get into their peak earning years and their peak spending years, which is generally their 30s, 40s, and 50s, right? In the 30s, people are having babies, they're forming households, they're spending all that money on the things that you do to establish yourself as a middle-class person. Go into debt to buy a house, buy that second car that you don't need, spend money on vacations that you come back and go, boy, I could have done the same thing in town, buy a whole bunch of toys that you use once a week, that sort of thing. Now, the millennials don't quite spend that way. They'd say, look, I want a snowmobile or a jet ski, but I'm going to use it, 8 times a year, 12 times a year. I'll just rent it each time, not have to worry about taking care of it, not have to worry about storing it, and all that sort of stuff. So the nature of millennial spenders versus boomer spenders is definitely different, right? So not only are we seeing the boomers head into retirement in years where their spending will be dramatically different, they'll spend a little bit more on vacations and a lot more on healthcare, but almost everything else they'll spend less on. So, we should be aware of that. The offset in the United States is that you have the millennials, which is just as big a generation, actually slightly better now, adjusted for some deaths of the boomers than the boomer generation, right? But they spend differently. Even though there's as many millennials as boomers, adjusted for inflation, they earn a little bit less. They actually save a little bit more than the boomers. So let's give them, the millennials, credit for that. They do save more money as a percentage of income than the boomers. In fact, it's by like 5%, so it's a pretty big number actually. But their absolute incomes are lower, adjusted for inflation. So relative incomes are lower. Second, they do spend differently. So going back to the boomers, one of the things with them is that because many boomers have pensions, right? Xers, millennials, not really so much in pensions. The boomers are pretty much the last generation to be pension heavy. The institutions that invest pension money are now in overall distribution, meaning that they're taking money out of investments to pay out the pension checks. Make sense? I think that should make sense to everybody.
Yeah, definitely.
And there's a website by a guy named Yardeni. He's an old government official. I believe he was a central bank guy, Wall Street guy. Came up with just a way of measuring different cash flows into the markets and economy. And he points out that institutional investing, which is dominated by pension funds, has been in net withdrawal. So you see how this has been coming down pretty much since the financial crisis. The financial crisis forced a lot of people into retirement, right, because they lost their job. So they collected their unemployment as long as they could, and then they took their pension check. And now, since they've been taking their pension check, institutional money has been coming out of the markets, right? So there's a jump up in investments every year, usually from the January effect with money coming into pension plans, but that's been going down and down and down. So pensions and institutions in general are now net sellers of stock assets the last few years. And that's going to be a drag on stock markets for a very long time, right? Until the, somebody's talking about Yardeni. He actually, I can't remember if he worked for the Treasury or for the Fed, but he did have a minute when he was in government, or central bank. In any case, this is a drag. At some point, the millennials will be saving enough to offset this, and it'll start going back up. But it won't be the pension funds, it'll be different institutions. So eventually, you're going to see this go back up. But right now, the millennials just, even though they're saving more as a percentage of income, their income numbers just aren't high enough yet, and probably won't be for about 10 years, give or take, because as the last boomers retire, millennials will move into higher paying jobs. I know somebody in their 30s who's a CFO of a bank already. So,
nice job.
Yeah, when I met her, I was like, "You're a CFO of a bank that just went public? Wow!" So it's pretty interesting that millennials are moving into managerial, high-paying roles a decade early, maybe. So that is a big deal, and we'll have to keep watching that. The Xers, which is a small generation, my generation, is already in pretty good positions, but there's just not many of us. So that's a big deal. Now, I talked about how the Federal Reserve was making two huge mistakes, and I think you really ought to read some of these articles. Go back and read them, because things that are in the news now and in the last month, I wrote about what was going on with the Fed back in April. And in December, after Federal Reserve Chairman Powell talked about how, I still see raising interest rates in 2019, and we're going to have the quantitative tightening, right? The money that's coming off the Fed balance sheet kind of on autopilot. I think he used the term autopilot. Everybody went nuts and the market crashed. And so all of a sudden they've backpedaled, and they are talking about the two things that I talked about way back in April. And now all of a sudden, in the last couple of weeks, 8 months after I talked about it, the Federal Reserve is basically, hey, we may or may not raise interest rates this year, and we're talking about ending the quantitative tightening earlier. Now, I think what they'll probably do is reduce quantitative tightening without a commitment as to when they end it, but I think the $50 billion a month that's coming off the Fed balance sheet is likely to be reduced to 30 or 20 billion a month. My guess would be 30 if there's a hiccup in the economy in the first quarter. So we'll see. But that was another piece of money that was weighing on the economy. And of course, if you weigh on the economy, you'll end up weighing on markets. We also talked about the Chinese money that wasn't in the market. Direct investment in the United States fell off of a cliff, right? Look at these numbers, and then look at here. Fell off of a cliff. And there's a lot of money not going into real estate, which is why real estate has plateaued, or the stock market, which is why the stock market has, had the fourth quarter sell-off. And I talked about this way back in, I don't even know what I wrote this article for. Well, this is the December article, but this is not the first time I used this chart, which was about the marginal buyers in the stock market. So I think this is from August. So in August, I was talking about how market depth was disappearing. So your marginal buyer, your buy the dip investor started to disappear over the summer. And that thinness in the market manifested in the really unprecedented correction in December, right? I mean, December fell off of a cliff, and it was very fast. It was lucky that we had done a little trimming going into it because, of course, our oil positions took it on the chin. But, we had some cash, got invested again the last week of December, first week of January, and again, started trimming again last week before. Got a major part of the rally. And again, that's not, we don't sell everything. We don't, we're rarely fully invested. We're rarely out. It's an ebb and flow thing. Sometimes 75% of the money is in the market with a quarter out. Sometimes it's 50-50. But, it's rarely less than half of our money is invested because, of course, you can't really predict the short-term movements incredibly accurately. But if you can do some ebb and flow trading around the big rallies anyway, not the daily little things, but the bigger swing trades, and we'll talk about that in a minute, then you can pick up a point or two here and there, and in the long run, that point and two here and there add up. So in any case, the off-market buyer or marginal buyer disappeared, and so with no depth in the market is vulnerable to gapping down. Well, that's exactly what happened. So it's not as if these things are unanticipated. It's that even when you can't anticipate something happening, sometimes the market is much more extreme. And I think we should learn from that the market has the ability to be much more extreme in its movements because there isn't the quantitative easing from the Federal Reserve to make up for the demographic lack of money or reduction of money going into the stock market. So really the central banks are offsetting demographics, which is why I have talked about we need the central banks to be relatively easy compared to the past, probably for decades, right? We're not going to see 5 and 6 and 7% interest rates because, simply put, nobody could afford it. So, Ben Bernanke gave a series of luncheons to prominent investors and industry people after he was done being Federal Reserve Chairman. And a guy who's also a poker player like me, David Einhorn, who is one of the few people to call the crash back in 2008, asked Ben Bernanke at lunch, hey, when are we actually going to get normalized interest rates? Do you know what, Dave, Ben Bernanke's response was to that lunchtime question?
Never.
Not in my lifetime.
Yeah,
right. And here's a guy in his 60s saying, not in my lifetime. So, Central Reserve Bank chairman, professor at a big time school. I'm saying, hey, and he is a depression expert. So when he says we're not going to get normalized interest rates in his lifetime, I think it's pretty important to listen because he's probably got a clue, don't you think? So
absolutely.
When interest rates started to go up a few months ago, I said, hey, this is going to be a short-term thing. So you have people out there saying, oh, interest rates are going to 7, 8, 9, 10%. Frankly, anybody who believes that, I'm going to say it right now, they're dumb. They are ignorant of the reality of the markets today. They don't have a clue as to how the economy is going to shake out over the next couple decades. The demographic headwinds are massive. You cannot grow an economy without more spenders. So that's just reality. Now, we're going to continue to have more people enter the middle class from emerging markets, but we already saw half of them in their economies reach middle class. Now, it's not an equivalent of American or Western European middle class, so they all still need to take a step or two up, but they're not in poverty anymore. And that was a big hunk of people that pushed the economy up in the 80s and 90s and up until the financial crisis because they were moving from poverty into the middle class. Billions of people. So we are in this smoothing phase for the next couple of decades, probably 3. And we have to wrap our minds around that. It's just not going to be like the way that it was. There's going to be pockets that grow, and there's going to be pockets that don't grow. But the pockets that don't grow are probably actually going to be crushed. There are going to be industries that just get totally taken over by automation and changes in capital structure and changes in demand tastes. And we have to really steer clear from those industries. The deciding factor, I think, to the fourth quarter complete decimation that we saw was the fact that hedge funds were liquidating. And when hedge funds liquidate, you're losing another big hunk of money. So another $11 billion came out, and you really take a look at it, and you're like, okay, when will this money go back in? And it will. Most of this money will get reinvested, but by the time people receive their check from the hedge fund in December, January, February, they figure out how they want to reinvest it. They have to get over their own fears. you know, they really don't get the money reinvested quickly. So my expectation is that the money that came out of hedge funds will go back into other types of investments, not necessarily hedge funds. Some people have given up on hedge funds, and a lot of hedge funds stink because the fees are too high and the management is, you know, looking for home runs because that's how they make their money versus grinding out 10 to 15% gains, which is probably the better way to do it, which is what we try to do. So the hedge fund liquidations tip the market over when you consider all these other headwinds that are out there, you know, the demographics, the Federal Reserve not compensating for demographics in the second half of last year, the lack of foreign direct investment, you know, the marginal buyer disappearing from the market because boomers don't invest anymore, they're pulling out. And then finally, probably the straw that broke the camel's back is the hedge funds are all selling. So, you know, the stock market tanked in the fourth quarter, particularly in December. For folks who don't know this, December was the worst December since 1931.
Wow.
Yeah, that's a pretty big sample size, right?
Yeah, there wasn't any Santa Claus rally.
There was no Santa Claus rally. Well, we did get a Santa Claus rally.
It was just
started the day after Christmas.
Yeah, right. That's right.
You know, so we had a massive rally from the day after Christmas up until basically a week ago, and that had to do with you know, value investors coming in and buying, and then a whole bunch of retirement plan money that did come in, and now all of a sudden it's turning over. And why is it turning over?
Now you have the uncertainty again with the trade deal with China.
Let's not try to divine a reason. There's less money coming into the market. That's really what it comes down to. There's less money coming into the market. Why is that? I've talked about this in the past. I don't know if I talked about it in this. I did not talk about it in this article, but we have the buybacks. Which article? The buyback bubble will end badly. So I talked about this way back last March, that we have huge buybacks in the market, and that's something that is a inflow into the markets providing demand. And 2018 was a record year for buybacks, but of course, from about the middle of the first month of each quarter to the middle of the second month of each quarter, that month, those 4 weeks or so, we know that buybacks are only about half of the normal pace. Why? Because the way the buybacks work is that if you have a scheduled buyback from a company, and buybacks are when a company buys its own stock back, and there's big uproar from the couple of senators, Bernie Sanders, saying, oh, they shouldn't be allowed to do buybacks unless they do this, and unless they do that, and they have to have this, and they have to do that. You know what? I generally vote Democrat. However, these guys are freaking idiots. They're just playing to their base the way Trump plays to his base, and that makes them no better. Look, buybacks are good. Get it out of your system if you think buybacks are bad. Buybacks are good. It allows management to make a decision. Now, some management's good, some management's bad. If you're a shareholder, you should take, you know, interest in whether your management is good or bad. But management of a corporation, if they can't grow their business, if they can't invest your money in a good way to grow the business, wouldn't you just like your money back? Right? You return money to shareholders through dividends and share buybacks. And share buybacks are way more democratic than dividends. So a buyback reduces the price of your stock because they're reducing the demand, right? Supply and demand of stock, demand comes down, price goes up. And, you know, we can whine about how corporate CEOs are compensated and everything else. Look, if you think the CEOs are overpaid, and I agree that probably half of them or more are, then we should have a law that says, look, you can't make more than 100 times what your average worker makes, or 50 times, whatever. Around the world, it's 6 to 12 times. If the average worker at a company is making $50,000 a year, in Japan, that CEO is probably making less than $1 million. But in the United States, if the average employee is making 50 grand a year, our CEOs with all the different types of compensation are probably making 5 to 10 million in a year, or 15 or 20 million in certain years, depending on how their vesting schedules work on the options. So if you really want to control wealth inequality, then don't let the corporate boardrooms raid the corporations, right? The companies that you've invested your money in, and take your money, because that's what they're doing. They are taking your money as a shareholder because they are overpaid probably by 5 to 10 fold. Not 10 or 20%, 500 or 1,000% if you're talking about relative to the rest of the world. Are our CEOs blowing out the doors to the point where the American economy just grows and grows and grows? No, they're not. They're doing a good job, but the reality is that there's a certain diminishing marginal return at some point. And to allow these corporate CEOs to take out literally billions of dollars a year out of corporations that you invested in, you're an idiot for approving virtually all of these compensation plans. Because when Jamie Dimon at JP Morgan, who I think he's probably a decent guy at some level, and he's certainly a pretty good bank CEO, when a guy like that becomes a billionaire, even though he completely contributed to the financial collapse of the world in 2008, if he had done that 80 years ago, he'd been jumping off a building. 2 or 3 years after the financial crisis, he was getting $10 million bonuses again. Look, let's just call it for what it is. It is gluttony. It is completely out of line, and it is irresponsible, and we didn't hold people accountable. And it's going to happen again if we don't wake up to that. Now, does that mean that we shouldn't allow buybacks? No, because when you do the buyback, the money comes back to the public, and then it can get reinvested somewhere where there's more growth more efficiently. So it's a recycling of the capital. You can't say, well, pay everybody $15 an hour and give them this type of health benefits and give them this and give them that. Look, the one thing that I heard Bernie Sanders and I think it was Schumer say is that a company that's doing corporate buybacks but doesn't have a fully funded pension fund, they shouldn't be able to do their buyback until they fund the pension. Right. I think that's legit. And in fact,
sounds like a...
yeah, does that make sense? I mean, if you have obligations to bondholders and your pension fund, you should probably be obligated to take care of those first.
Yeah, absolutely.
Give money back to shareholders, which, you know, does largely benefit the corporate executives because they're largely paid in shares. So I think that makes sense. You know, you should have a fully funded pension, and you should maybe be, you know, net debt free. You know, you should have as much cash as you do debt, something along those lines. But to start legislating how a corporation should be run, I guess the question I would ask is, if you were so good at running a company, why didn't you do it? Right? You got 90% of these Congress people who have never even really had a private sector job, a lot of them, and they've for sure not run a company. How can they tell corporate executives how to run their company? You want to change the social contract a little bit, tweak around the edges, have some common sense financial goals. I get it. I'm all for good, light, smart, efficient regulation, but, you know, we don't always get it. In any case, back to the buybacks. When you get a lot of buybacks, shares outstanding go down. You know, there's about 20 million shares disappeared over the course of a decade, which this chart makes it look much more exaggerated, but you got to take a look at the axis here. 290 million, 310 million. It's only 20 million shares. So what is that? It's about almost 10% of the shares have been bought back in a decade. It's really not that big of a number, but it is enough to offset the reduction in demand for the stocks in the first place, right? So it's another one of those offsets. If we got rid of buybacks, I categorically guarantee you the stock market would crash. Overnight, 30 to 50%, like that. All of a sudden, you'd have a crash and it would fall off the edge. So we should be aware of what's going on. Our core 4 analysis, right, the things that we do to analyze the markets start with the big global macroeconomic trends, followed by government and central bank interactions and policies, followed by fundamentals, followed by quantitative analysis to give us price trend flows. And what we've been learning is that the interaction of all these things is important, but ultimately we need to respect the demand for stocks. And if the demand for stocks goes down and the supply doesn't go down, you're going to have a problem. So, I would read this article too. The buyback bubble will end badly, and I think this could be 2020 because buybacks in 2019 will actually be greater than in 2018. And I will tell you right now, I think after this little lull that we're getting in the stock market that should last another week or two, we could be off to the races if, I'm gonna put that teaser, if something happens. If something happens in the next month, we could see the stock market go on a monster rally. So, Fed's making 2 huge mistakes. If you haven't watched the video, here's the video on 5 pieces of missing money holding the markets back. And let's talk about the little slump that we've had in the last week, right? So U.S. stocks are kind of rough right now. Why is that? Well, why is that? Oops, didn't mean to do that. Reopen, please, Mr. Browser. Not sure why it always makes me ask twice. But you've got a lot of earnings going on right now. So the next 2 weeks are the last 2 big weeks of earnings. This is the calendar at Seeking Alpha, which is a pretty good calendar. I like the one at Yahoo because it shows me how many earnings are going on. So this week we had a lot of earnings: 139 on Tuesday, 151 on Wednesday, 176 on Thursday. Big week. And then next week we still have some big days. And then the final big week is pretty much this 3rd week of February. And then after that, it really starts to fall off of a cliff. Well, actually, the last week of February is pretty big too. Going into March, there you go. Going into March, it starts to really fall off. So the next couple of weeks, we still have a lot of our earnings being announced. Why is that important?
That could provide a good catalyst either way.
Well, because during buyback season, during earnings season, the companies have to stop their buybacks. Not all of their buybacks, but a lot of their buybacks. So again, going back to the way buybacks work, if it's scheduled, you're allowed to continue doing the buyback. But if it's discretionary, like the CFO just says, hey, the stock is down today, I want to buy some, they can't do it during the period leading up to earnings. And I believe the rule is 15 days or 21 days. It's something like that. It's generally 3 weeks leading into earnings. They don't do any discretionary buybacks of shares. So you get this reduction in the buybacks during earnings season. And right now, I think it was yesterday or today, is the peak of the reduction in buybacks. So over the next couple of weeks, buybacks will start coming back because, of course, this week we had all these companies, these 400 companies can start doing buybacks now if they want to. And all these companies can start doing buybacks already. But it's really the big companies we should be looking for. So the big companies, what big companies are going to be doing earnings next week? All right, so we've got, let's pick a day. This week, Tuesday. Who's on this list, right? So of the companies that are doing big buybacks, Occidental. So Occidental can start buying back shares after Tuesday. That's a company that we're in. This is a company I'm looking at, by the way, folks. There you go, freebie. Go on right through. And, of course, we have the list that I gave to folks of companies, and I think the watch lists should have it. I think it's still in here. Do we still have the, or did I take it down? I did take it down. We have a list of stocks with big buybacks. So I keep it over here at Y charts, equity screener, open, And where's my buyback list? Buybacks. So we go through all the companies with big buybacks, and you can see who's buying back shares. So that was one of the criteria, who's buying back shares. So we have 411 companies out of 3,000 in the Russell 3000, which is, like 98, 99% of the market cap. 411 companies are doing buybacks. Now, for my money, most of the companies I invest in are on this list. I have some smaller growth companies that don't buy shares back, but once a company is about halfway up the S curve, if they're not buying back shares after they've been in business a while, I wouldn't look at them too closely. I have another list, and this is the more recent companies that just started doing big buybacks, so I may have more impact on their share price. Here's a company that our investors will know, Devon Energy, right? I like Devon Energy a lot. I think they've moved for a non-little growth company. I think they've moved in the direction of be my favorite. I like Encana. Encana's buying shares back too. We can break this up by industry and take a look at who's buying what. All the defense contractors are buying back shares. This list is showing big increases in share buybacks. So 199 of the 411 companies doing buybacks, 199 of them in the fourth quarter really increased those buybacks dramatically. So you can see in the previous 12 months, General Dynamics had bought back $1.76 billion worth of shares, but $1.23 billion of that was in the fourth quarter, right? So a very, very back end of the year weighted. And a lot of these companies, dramatic increases in their buybacks. Part of that had to do with money that got repatriated, took a little time. And then part of that has to do with just, what they decided to do. So if we go to the oil and gas, which I know is on a lot of people's mind because we have a sizable oil and gas position, we'll see Devon and a few others. There you go. So Concho, which is a company on our list. We haven't invested in them, but we could. Devon Energy, Marathon Oil I've talked about, Newfield Exploration.
That's when it's been acquired.
Yeah, they're in a merger with Encana, Occidental. So you take a look at these, and you're like, Baker Hughes is buying back shares. I think if you're going to get into a service company, I'm not terribly excited about service companies. I think Baker Hughes is the one. I know people talk about Halliburton, Schlumberger. I think Baker Hughes is the winner here because GE is capitulating to them. They're buying back a ton of shares. We can take a look at the cash flow analysis on a company like this. And again, I'm not telling you to invest in them. I just want to show you how I would do the analysis. Is first off, you have to make sure the fundamentals are good. I know the fundamentals are pretty good. I'm not going to go through that with you. But then you have to decide, do I want to invest? And if I do want to invest, when do I do it? Well, the money flow into the company from the end of December to about 2 weeks ago was really good. Now the money flow is falling off. What do we know about money flow? What happens to price when money flow goes up?
Follows.
Price goes up, right? Money flow, money into the company went up, price went up. Company went from oversold to just about overbought. And now it's turned over a little bit. Now the divergence is not quite what you'd want to see, right? Make it a little easier to look at, right? You usually want this blue, that's harder to look at. You want to see this divergence going up. See the little check marks there? You want to see those going up. Divergence goes up, price goes up. So you get almost a week, lead time. But here's something to take a look at. What does it look like over a longer term time frame? Since early last year, there's really been no increase in money flow. In fact, it came down from spring. So are these bottoms? Are we going to revisit those bottoms? Or are we going to see money flow go up? Here's what I will suggest. I will suggest that money flow is going to vacillate from neutral to slightly negative for quite a while, until we see either the Federal Reserve back off or the economy really heat up. And I know that people talk about the economy being hot right now, but hot is a relative term. You need increasing growth or increasing cash flows to see money fall to the bottom line. And right now, a lot of companies are basically stretched. They're trying to keep up with demand, and so they've expanded their labor forces. They've invested money in technology, and now all of a sudden the economy is slowing down a little bit, and they still have bills to pay. So these market dynamics, they fluctuate. Management adjusts, small owners adjust, whoever it is. And then the economy does something, and they have to adjust again. So it's a constant push and pull on your companies and with the economy, and you eventually have to adjust. And it's just like an investor, you have to adjust. So when we talk about investing, we want to be aware of these cash flows. And I would think that a lot of these have bottomed at the end of last year, and that's why we saw the rally. But that doesn't mean they're not going to turn over. So when we take a look at the bigger economy, here's the QQQ. We want to take a look at, first of all, the daily chart is what everybody looks at. Everybody's focused on the last couple of weeks. Last couple of weeks, huge rally. But I would suggest take a look at the longer time period. This is measuring week-long periods. So whereas this chart measures 20 days, this chart measures 20 weeks. And often I'll actually use 26 weeks. But for sake of simplicity and clicking back and forth, for the last year, money flow has gone down, trended down. Will it bottom out again here? Again, I think there's a binary event that will either have the market bottom out again or take off. We'll find out, I think, in the next month or two. S&P 500, same trend. But money's been coming out of the market since February. And February marks when the Fed went to, I think January was 30 billion a month, because October was 50 billion a month. Right? Let's go backwards. October, the Fed was taking 50 billion a month out, July 40 billion, April 30 billion, January 20 billion. So in October of 2018, they started taking 10 billion a month out of the market, and by January it was 20 billion. So what we know is that the market probably can't handle more than 20 to 30 billion a month coming out from the Fed. And that money probably has to be allowed to stay in the markets and in the economy. We'll see. And then this is the total markets from Vanguard. Again, take a look at the daily, big rally. If you're a swing trader, right, you can really do some damage if you get, some good damage if you get these swing trades right. But we should be aware that the longer term trend has been down for a year now. And that's pretty important. So will we see these turn over and bounce all the way back down to these orange lines? Maybe. Don't know. One thing I would say here is that when the markets get volatile, you have people come out of the woodwork, or really they just continue to chant what they've been chanting for 10 years, which is that we're going to have another bubble and another crash. And they're right about that. There will be another bubble, there will be another crash. Eventually, but it's not any. Yeah, it's just natural. But it doesn't happen very often. For people to think that we're going to have a bubble and a crash every 10 years is insanity, because it just doesn't move that fast. We probably won't have another massive financial crisis for another decade or two. And it'll have something to do with the retirement systems of the planet not being able to pay for so many people being retired. But automation, technology, social programs, green investing initiatives, whatever the case might be, there will be offsets as well. But when you have people like, I'll tell you, there's a guy on the internet, his website is the Bubble, and he's, he kind of got a little bit lucky talking about real estate bubbles back in the early 2000s. He was just following along on somebody else. It was no original analysis. He's got a huge Twitter following. I've talked to the guy. He's a nice guy. He's with a good organization now. He left private industry to go into finance. But he's not a special investor. He's not somebody who really understands what he's talking about. He's got an ideology. He's got a shtick, and he sticks with it. So, folks will know who I'm talking about if they know who I'm talking about. And there's a lot of people out there like him that says, this is a bubble, that's a bubble, global debt, this bubble, that bubble, the other bubble, bubble. And it's going to be a crisis. It's all going to go to hell. You know what?
I'm usually selling gold and silver and that kind of stuff.
Exactly. And so when you compare gold to the stock market, you'd have been so much better off putting your money into an index fund 50 years ago than into gold. You just go through the list of bad investments that people pitch. It's snake oil. It's just garbage. So what you really want to do is, there's some guy in Omaha, I think his name is Buffett or something. He talks about, look, find productive companies that have a comparative advantage. And that's what we've been doing. The problem is that in the last year, we've had this downward draft and money getting invested into the markets, and that has offset some of what I think are still really good ideas. But the reality is, there is one thing that's caught me a little bit off guard, and I'm going to talk about that in a moment because it's important. But there is no pending crisis. There just isn't. Even though there's as much debt today as 10 years ago, the fact of the matter is that the global economy is roughly twice as big. When you factor in all the money creation, it's twice as big. And this idea that we're going to have a crisis that can't be fixed is wrong. I talked about that in an interview with Brian Bain over at Investor in the Family. The helicopter money is inevitable. Ultimately, the way the financial and economic system works is that as the pie gets bigger, everybody's standard of living gets better. The problem that people say is that they climb onto is that, well, there's all this debt, right? So people who think that they're conservative say, well, you can't run an economy like that. You certainly wouldn't run a household like that. Well, the economy isn't a household. It's a stupid comparison. It's ignorant of the fact that mass psychology won't allow for a big depression. So getting out of the next depression or financial crisis is going to be a simple matter of, do you borrow a ton more money to get out of it? Or do you say, why don't we just correct for all the debt that's on the planet? Why don't we offset the major deflationary forces that are out there and create some inflation by just printing the money and paying off the debt? And that's what they're going to do. I categorically guarantee one thing in my career, that during my lifetime, presuming I don't kick the bucket soon, we will see helicopter money. And the way that it should take place is that we should just bail out the retirement system, require that money be invested in bonds, pay off a bunch of bonds, right? Fully fund the retirement system. And then rather than having 30 or 40 trillion dollars just go into the economy and cause inflation all at once, what will happen is that it'll trickle in through retirement payments. It'll trickle in through the Social Security system. It'll trickle in through the pension system, because people will get that money over 30 or 40 years, over a very long time period. They will spend it. It'll recycle through the economy. Capitalism works when money is recycled into the economy. So anytime you hear about free education or free healthcare or free this or free that. Look, gotta be
somebody's paying for it. Exactly. Yeah.
That somebody's got to pay for it. So if you took all the money from the 1% richest people on the planet, you still couldn't pay off the debt. Right? So I'm not saying that I don't think that there should be higher taxes on the super wealthy. I think there should be, because we don't control how much they can make. So if we're not going to control how much they can make, then we should at least tax them at the end of the day. And there's a lot of people that I know, real estate investors in particular, who are multimillionaires and they barely pay any taxes, right? Because you can hide your wealth in the real estate. One thing that people don't realize is that most accumulated fortunes of over $10 million have never been taxed, or at least about 2/3 is a statistic. That money's never been taxed. Why? Because it's been in a deferred growth asset, whether that's real estate or some sort of company or security. It's usually real estate or a company, not necessarily a stock. But when you take a look at that, you're like, okay, so Joe over here, Joe the real estate guy, has $100 million in real estate, but 90 million of it has never been taxed because he just held it all that time, right? If there's no transaction to sell it, it doesn't get taxed. So you got people like who's the one that Trump calls Pocahontas? Elizabeth Warren.
Elizabeth Warren, yeah.
Yeah, Elizabeth Warren coming out there saying there should be a wealth tax. Well, here's the thing. It would be incredibly hard to do, right? People would just cheat and hide or change their nationality. So the best tax out there, in my opinion, is the estate tax. And everybody goes, oh, no, it's a death tax. Well, no, it's you never pay taxes on that money ever before tax. That's what it is. Look, you had a piece of real estate that went from 10 million to 20 million. You never paid taxes on that. When you die, you should pay taxes on it. So, the estate tax, in my opinion, is a way to clean up a lot of messes that, it's good that we allow deferred taxes, right? Because it allows people to accumulate wealth, allows them to reinvest in other things. Great. But at the end of the day, unless you need the capital to run like a family business or a small business, and there's already rules to protect those people, right? And the farmers. So there's already rules to protect folks from having their business destroyed by estate taxes. So if you have just a deferred gain on an asset, right? A highly appreciated asset is what it's called. That's a great place to increase taxation. It allows for recycling of money back into the economy, and it increases charitable giving, and it creates economic activity, because the easiest way after giving it to charity to avoid the tax is to just buy a life insurance policy. You buy a life insurance policy, you die, it pays the taxes for you. Pretty simple. So, when you hear those arguments about estate taxes, I think you should take them with a grain of salt. The death tax affects less than 1% of the people, the estate tax, whatever you want to call it. But it's, in my opinion, the best tax out there, created by who invented the estate tax? Come on, Republican or Democrat? No guess, Dave? Republican, damn right. You knew it was a trick question for me. Yeah, it was some guy named Teddy Roosevelt, right? And he was a tough guy. So, the estate tax is there to prevent dynasties from taking over the country, which is kind of the problem we're having right now. So if you tax people at death, even if they have a way to defer the income for 50 or 60 years while they're alive, that's fine. The estate tax system is a great system. People trying to get rid of it are just trying to preserve, their own dynasty, and that's not very American. So in any case, we know that the money going into the markets is gone, but when the market is volatile, people say bubble, bubble, crisis, crisis. Just remember that we probably won't allow a bubble, bubble, crisis, crisis to happen again, because we've already seen it. The last one was the Great Depression, right? These things don't happen very often. They're not 10-year events or 20-year events. They're multi-generational events. Will we have something horrible down the road? Yes. But when the next crisis hits, probably having to do with the retirement system and the accumulated debt. Pufto, presto, Japan, China, the United States, and Europe are going to print money. They're going to do it together. It's going to be offsetting. It will not cause anybody to go under. The dollar will probably still be the reserve currency because who else are you going to go to? And, you know, it'll all be okay. So it's all going to be okay guy, even though it's going to be a bumpy ride, right? So there's lots going on. So hurry up and wait, right? There's a lot of news out there. This is the snowstorm we had a couple weeks ago in Milwaukee.
Nice.
This is the Chihuahua saying, I'm really angry at you for making me go out there. So I took pity on him, gave him the puppy pads to take in the basement. And lots of moving parts in the economy. You got Brexit, you got Venezuela, you know, you got oil, you know, you got your first climate change bankruptcy with PG&E. Probably wasn't the first, but it's the first big one. You know, they want to cut a deal with China, but at the same time, they're going after Aoi executives for cutting deals with Iran. You know, there's a lot of moving parts, and it can become overwhelming. Ultimately, a lot of it comes down to monetary policy because the fiscal stuff eventually works itself out. There's this guy named Churchill, Winston Churchill. What did he say about the Americans? The Americans will... You can count on the Americans to do everything right, do things right after they've tried everything else. And I feel like we're kind of in the try everything else phase right now, but eventually we'll do things right. We have to make sure that new Congress people who fall under the Bernie Sanders wing don't screw up capitalism, because if you want to see something worse than screwed up capitalism, have socialism. And I don't mean... You know, in fact, I actually do mean Western European style socialism. That doesn't work either. I've already showed in the past the reason why socialism has worked in Europe is because they had wealth from previous empires that they could burn off, and they had oil money in places like Norway. If you throw out empire wealth and you throw out oil wealth, those countries are going to have a very, very hard time sustaining their level of socialism.
And probably more like Venezuela.
I don't know if they'll get that far into the hole, but you know, because they're not dictatorships with politicians stealing all the money. Like Putin stealing all kinds of money from Russia, and Russia after oil could be a basket case. So you know, the fact that Putin's worth billions of dollars, maybe the richest guy in the world, and his oligarchs are super rich, they've basically skimmed money out of Russia, and at some point that might come home to roost. You know, we have to consider that what's coming for the United States in the next year or two is really dependent on two policies in particular. First is Fed policy. Second is trade policy. The Fed is clearly on pause. We know that. They've talked about it in the last month. We already covered that. And the next thing we have to know is,
what will be the outcome of this trade policy?
Right. Will President Trump cut a deal with China? I think that he will. And if he does, these charts head up.
Yeah. They just prolonged it. So he wasn't going to do anything until March.
Right. Where did my article go? If he doesn't cut a deal with China, then we probably double bottom. And we probably have a recession. Now, President Trump knows he has no chance to win next year if the economy is in recession. No president has ever won when the economy was in a recession. People take it out on him. He knows that he has to have a good economy next year. And if he doesn't, you know, what's going to happen? If there's no deal with China and the economy goes south, what will Trump do? He'll blame it on the Democrats.
Right.
Come on, folks. Don't fall for it. If he doesn't cut a deal with China, it's his fault if we have a recession. And I'm telling you that now, and I'm going to pull this up in a year or a year and a half if we're in a recession by next year. I'm very afraid of it, but at the same time, I know that President Trump is a survivor, and I believe he's going to start co-opting some Democratic policies, and I think he's probably going to cut a deal with China. What's an example of a Democratic policy that he's already co-opted? Who watched the State of the Union address? What did he say? And then what did he reiterate this morning? Nobody? He said that he wants more immigration, but for it to be legal. He said that he wants more immigration than we've ever had before.
Just do it legally, that's all.
That's right. Well, but more importantly, he tied it
or give him a pass. Yeah.
Well, he tied it to the economy, right? He said that we need more people to work. Okay? So that's actually true. To grow the economy, you need more people that are working because there are more people spending because they're earning money, right? So somebody whispered in his ear, one of his economic advisors, hey, we need to find out a way to get more people in here because the immigration will support the economy. So I think he's going to probably try to do all the right things. And if he doesn't, it's because somehow he's convinced that fighting is a better idea. And we'll see. But those signals are coming. If
that could be a key growth driver for the economy. I mean, you got to add that to the millennials.
Yeah, huge.
And immigration along with that. That'd be great.
I mean, if there's a deal with China and the economy gets strong, that means that there won't be any hedge funds selling this year because it'll be an up year. Hedge funds sell in down years at the end of the year because they close their fund. It's based on their compensation scheme. Hedge funds in general get paid year to year, not 3 years to 3 years or 5 years to 5 years. So hedge funds close at the end of down years and they return money to shareholders. Then the guys take a year off and they start over. So if this is an up year because China, they cut a trade deal with China, then probably it's a big up year. And probably we set a new high on the S&P 500. I said a year ago that the S&P 500 is about to rally up to 300, and it almost got there. It got to like 293 or something, 294, 293.94, yeah. So I missed by literally, what was that, 3%? 2%. Missed by 2%. People said I was wrong. Oh, yeah, I missed by 2%. It's like being on The Price is Right and only being $200 off on the Showcase Showdown.
Yeah, but you're under, you usually win. So.
Yeah, right. I mean, I didn't go over, they didn't disqualify me. Right? So, all right. So if the economy's good, then all the people who have been talking about the global slowdown are going to be wrong, right? If they cut a deal with China. Because China is already doing stimulus, and we're trying to figure out ways to do it too. And in fact, if there's no deal with China, that's not a guarantee that we have a recession. It's just very likely. The reason why oil is headed to 80 is because all the fundamentals suggest that there's a shortage developing in oil. So I would read this article. I don't want to spend all day on it, but read here's why oil is headed to 80. All these things are true. I wrote about them before they happened. You can find verification after the fact now. Saudi Arabia's response to oil has been a big deal. I talk about where oil comes to and goes from. Talked about the refining system. We're going to have a very, inventory started to fall off already. We're going to have oil prices rise. Again, they got into I said they'd get to 80, they got to the mid 70s. I'm saying 80 again. Maybe they only get to the mid 70s again. Who knows? But we've been very close on these. The problem is we had that complete tank at the bottom at the end of the year, and that kind of blew up our trades. We should have been getting out in here a lot more than we were. We were closing some positions. We should have closed them all. So if we get another rally like this, we're going to close them all probably, and here's why. One of the reasons why oil really took it on the chin, not only because the market was taking it on the chin, is because over 1,000 institutions have been divesting from fossil fuel investments. And the millennials aren't big on fossil fuels. So the next big rally is going to be those companies that are hugely profitable, and that's where we want to be. So the shale stocks, the ones that aren't in debt, the ones that have good shareholder yield, which is the shareholder yield is the combination of buybacks, dividends, and debt reduction. It's a very good measurement of management responsibility. So companies that have a shareholder yield of like 14%, like Devon Energy, They're reducing debt, right? Net debt issuance. They cut almost $1 billion of debt. You see it right here, right? And they're returning money through buybacks. And where's my dividend? And they're paying a dividend, right? And they're increasing the dividend. See, dividend went up. So companies like that are really where you want to be. I can't say enough good things about Devon Energy or Occidental and several of the other companies that we talk about with subscribers. So in the oil patch, that's how it's going to work. It's going to be the best companies, make a lot of money, but the other ones really aren't going to attract much attention. So, we talked about quick thoughts on some of our stocks, Occidental, Devon, Continental. I've gone through this in other webinars, Encana, Parsley, Centennial is in here somewhere else. I didn't bold it. Because people always ask me about Continental, Continental is the first one you sell because they are not a hedged company with their oil. So once the price of oil stops going up, they're in trouble. So you ride them up because they're a proxy for oil price, or you could skip it. You could just skip them if you wanted and go with the other companies. So last thing that we covered today is this whole Green New Deal. I talked
AOC.
about how, what was that?
AOC.
Yeah. So, but it's not just her, so she's apparently Twitter is what makes you smart now or makes you popular now.
Yeah. The loudest person.
Yeah. I'm going to start tweeting a lot more. I'm just going to say crazy stuff on the Twitter.
Yeah.
You should be following me on Twitter, by the way, because I do announce a lot of stuff. And if you want to see it, just follow me on Twitter at Kirk Spano. And wow, got a lot of people talking back to me today. We'll have to go take a look at that in a minute. But anyway, one of the biggest new trends is this whole climate change issue, and also because it's an economic stimulus issue. So the Green New Deal, they're cloaking an economic policy in sustainability and climate change. Now, we could do this right or we could do it wrong. The bill that's out there now is basically a broad range of suggestions, and it's okay. But the thing that we're going to have to watch is, do they require taxation, more taxation, and more government spending, or do they utilize the markets to drive these things? Already, you have corporations moving towards alternative energy because they know that it saves them money in the long run, and they have the money to make the investment that maybe at the household level you can't do because you have to borrow $20,000 or $30,000 to outfit your house in solar panels and batteries. But at the corporate level, there's a lot of corporations, Google, Apple, who are moving, Walmart, who are moving towards being 100% alternative energy driven. And that's a big trend. So the corporations see value in doing it because they have the ability to finance. They go ahead and do it. At the household level, it's harder because not everybody can refinance their house and do it, even though over 5 or 10 years it would make sense. But the Green New Deal, and I'm going to start writing about this on Medium. I have a Medium page. I haven't used it yet, but I'm going to start writing, and it may largely be a response to the millennials. In fact, I think it's going to be very millennial driven because I want them to get a little bit more educated and hopefully realize that everything that sounds sweet and dandy comes down to the details. And I think it's a generation that will listen to that. I think the millennials will listen to facts-based presentations, even though I think it's a passive-aggressive, cynical generation. And they listen to some people who may or may not have all the right ideas. I will say this. I think Alexandria Ocasio-Cortez is very ethical. I think she's morally in the right place. I think that she has to learn more about how the system works. She's 29. She will. I got 20 years on her. So I think she needs to learn a lot of stuff, go through a huge learning curve over a short period of time, because if she can embrace the reality the capitalism blows socialism away, and work on a regulatory light framework that is still effective. You don't have to hire more police. You don't have to hire more regulators. You don't have to create more rules.
Right. Just let the companies, give them incentive to do the innovations.
Right.
Create kind of stuff.
Help create the environment. Right.
Yeah.
One of the things that President Trump has absolutely done right, in my opinion, is he's been peeling regulations and things off the books as he puts new things on. I don't always agree with the new things he puts on, right? I think that his climate policies are remarkably bad, but he has been pulling lots of things off the books. We have so many bad policies on the books that just cleaning things up is I think, a help, right? I've read government manuals, I read regulatory stuff, I've read tax code. It's just so much gobbledygook. I think that the inclination of a lot of politicians and a lot of voters is more makes it better. Sometimes less makes it better. And we have to find which spots where we need more regulation or better regulation. And we also have to find the spots where we need to peel things out so that entrepreneurs, which are the backbone of the economy and are suffering right now, have a chance to get a leg up. Because as small business grows, the economy grows. And when small business stalls, the economy stalls. And it's been the same deal forever. So at some point, they need to turn to small business and say, this is what we can do to help you accomplish the same things that big business does. And it doesn't necessarily have to be a subsidy. It doesn't have to be government spending. It could just be saying, look, at your size, you shouldn't have to follow all the same rules or do all the same paperwork or hire all the same lawyers and accountants that this billion-dollar company does. You got a $1 million company with an M, you shouldn't have to carry the regulatory burden that a $1 billion company or $10 billion company or $50 billion or $100 billion company does, right? Because it's just not a level playing field then. So the Green New Deal is a real thing. Let's hope that they do it the right way. But what we do know is that with the Paris Agreement, the realization by 3/4 of the people on the planet that climate change is real and probably very largely man-made, or at least man-influenced, is so overwhelming to me anyway, that I have changed my entire investment firm. This website isn't done. There's lots of links that are broken yet. But sustainable investing in a changing world is where I'm going to. I've been known as the oil guy for MarketWatch, called the oil shale boom, called the oil crash, pretty much got everything right until the fourth quarter for a long time. And I had a couple of bad quarters back in 2015, when the Saudis didn't control the market as fast as I thought they would. The biggest trend in that whole secular macro core 4 approach, the biggest trends are towards sustainable investing. And we are going to have an alternative energy, smart grid, smart car, smart home, smart everything world in the next decade or two. Artificial intelligence, augmented reality, virtual reality, smart medicine. You go right down the list. Technology is going to impact everything. And it will either lead us to a much better standard of living, or Skynet is going to get us. But, one way or the other, this is the direction things are going, and it's happening rapidly. What really tipped me off to it was how many institutions were willing to sell off their fossil fuel investments. So that means two things. One, it's ethical at some level, but they have a fiduciary responsibility. And they are basically saying, we think over the long haul that fossil fuels are a bad investment. And while I think there's still trades to be made, the long-term trend is away from fossil fuels and towards all of these other things. The intersection of a sustainable economy and technology is what we're going to be looking at for the next couple of decades. So we have to find ways to offset demographics. We have to figure out ways to handle debt. We have to have growth. We have to keep growing the economy. There's going to be 9 billion people on the planet in 30 years. There's a lot of growth out there. There's a lot of good things out there. Is there too much debt right now? Yes, it's fixable. Is there too much pollution out there now? Yes, it's fixable. The solutions for investing in a way that will support you and your family, protect your financial freedom, and generate wealth are all going to be affected by these major trends. So within these major trends, if we can spot them, and I think they're easy to spot, if we can trade them well, if we can invest over the next couple of years in beat up great ideas, right, then probably over 10 years we get this.
Mm-hmm.
So even though we're dealing with this right now, right, even though we're dealing with this right now, right, we had that crash way back here in 2000. Look what it's done since then.
Mm-hmm.
Skepticism and accumulation followed by a massive bull market. And I don't know how close we are to the next big bull market. I suspect we get some chop here, but then it'll be off to the races again. And will there be more chop when demographic issues come to a head? Sure. So over the next decade, I think maybe there's a little bit more trading to be done than in the last decade, because since the financial crisis, things just went up. But now we're going to have a choppy period. And at some point, there's a big rally. And the big money is going to be in the smart everything world, the intersection with the alternative energy, and then the sub-industries, which artificial intelligence is a big deal. That's why Google is my biggest holding now. Google bought one of the best artificial intelligence companies in the world a couple of years ago. And I'll tell you, when you talk to your telephone and you click that little Google icon and you talk to Google, hey, Google, it's starting to answer you when you just ask a natural language question. You say, hey, Google, tell me about the game last night, the Bucks game last night. Hey, Google, who is this person? Hey, Google, what about that? And it gives you a pretty legit answer most of the time. Blow Siri away right now. Google is really impressing me. And I don't play with my phone as much as some other people, but I play with it enough to learn about it. And if you have the Google app on your phone and you're talking to it, notice how big of a change in just the last 6 months. It's a big deal. And it's going to impact a lot of the new things that are coming, like edge computing. I've got one client keeps talking to me about the cloud. The cloud is kind of played out. The next iteration of the cloud has to do with the edge computing, moving the computing power closer to the decision maker, the consumer. So there's a lot of new things going, and we're going to write about all that this year. Dave Zanoni I brought on. I've got 2 other people that I'm bringing on. One guy is specifically a retirement and dividend investing guy, because, if you're 65, 70 years old, you got 20, 30, 40 years to go maybe. I've got 2 grandmothers. One just turned 90, one's about to turn 90. And they weren't even, they're 30 years older than you. If you're a boomer, you better keep investing like you're going to live to be 100, because over half of you are. And that is something that I have a hard time getting across to boomers, is they just want to spend their money up a lot of times. I know not all of you. I know a lot of people listening to me, that's not true. But a lot of boomers are just spend. And it's something along the lines of 20% of boomers have pretty much all the boomer money. 4/5 of boomers are in serious spend down already. And that's a problem that we're going to deal with in a decade or so, give or take. But between now and then, and even going into then, we can find good investments that will benefit from all these big changes. We just have to use the money flow to help us out a little bit. So that's what I got for today. I know this one went long, but I know that a lot of people wanted to know kind of where we were at and the big picture. So we did a lot of big picture stuff, and we'll break down a lot of these things by topic more in depth as the year goes on, and we'll talk more and more about individual investments, why we're doing certain things. Dave, anything to close?
Yeah. No, I don't have anything else to add.
All right. I know that I kind of took this one over, but we're going to get Mr. Zanoni to tell us all about some of the companies he's researching in the not too distant future. So everybody have a great weekend. If you're in Wisconsin, it's cold again and icy, so hopefully you're taking care of yourself if you're in the cold part of the country. If you're in the warm part of the country, send some to us. Take care. Have a great night.
Yep. Have a good week, everybody.
Yeah, good weekend.